So let's do the memo. And the memo is extremely, like I said, extremely precise. So it's very detail oriented. When you're working with senior executive people, they have such attention to detail. They do not let one period or one little thing, get out of whack. It's got to be perfect. Okay, so if I'm nitpicking you or you think that I'm focusing on mundane little things, I'm not. Because the format and the correction of the memos and other documents has to be perfect. It has to be precise. There's nothing else. Because you can't let the stuff out in the corporation. You can't let it go out if it's not. And a lot of corporations have lost their brand and they've lost their reputation for sending out documentation that had flaws in it. Okay, and that's senior level management, and that's the marketing department's and the investor relations department's responsibility. So it's basically 8.5 by 11. It's all times Roman. Okay, 12-point times Roman, not Arial. 12-point times Roman. That's business font. The memo, where it says memo, I like it in caps and I like it bolded, and in at least 18 to 20 point type. Okay, the margins are going to be 1-inch margins, single spaced. Okay, not double spaced, single spaced. And if you're going to the second page, if you're running over, you just narrow the top margin, you narrow the bottom margin, which will give you more space. But do not go to 0.5 on either the top or the bottom, because it means that you're too wordy. You're using too much text. Okay, these need to be brief memos. Okay, the attention span of managing directors and senior executives is really short because they do not have time. So I need to be able to get through 60 of these in one day. Maybe I review 60 of these every single day. Okay, so that's why they all need to be standardized so that I can review them very quickly, know exactly where the data is in every single memo, and then be able to fund the ones that are really good and reject the ones that don't make sense. Okay, and if you get funded, you win. If you get rejected, you lose. Okay, it's that simple. Date to from RE basically states what the memo subject is going to be, and there should be spaces in between these two. Okay, you're going to come up with a sound bite right here, not stock prices or oil prices in quotes, which I think some of my examples were, which were legacy iterations of prior memos. You need to be really direct and tell me right off the bat what you're talking about, what you think. Stock prices to drop 9% over the next 3 months. That's it. What's the first question? Why? Why did you come up with 9%? Why did you come up with 3%? What are the factors that are going to drive the prices down over the next 3 months? I need to know. So you captured me as a reader, and then you're basically going to drive your arguments. So this kind of soundbite, this kind of title, if you look at the New York Times in the finance section, if you look at the Wall Street Journal, if you look at the Financial Times, if you look at The Economist, if you look at any major publication, they start off with a really strong opening that then draws the reader in and then captivates them. The language here has to be exactly the same, okay, because I'm reading all of the same stuff. We are tracking stock prices. It's going to be stock prices, oil prices, gold prices, bond prices, and the value of the dollar. We forecast, not I forecast, we forecast prices to drop, not decrease. This is the difference between business writing and student writing. Students use decrease and increase. You do not use that in business. In really good business briefs, you say stock prices are to drop, are to fall. Stock prices are to rise. Very strong, sharp language that just keeps the attention of the reader. We forecast stock prices to drop 9% over the next 3 months, and you want to bold the part where it says drop 9% over the next 3 months. You want to bold that right there because it's going to stand out. And again, bolding is great because it makes things stand out so you can scan stuff and pull out of the memo some of the key data and some of the key concepts that you're trying to communicate. Based on the following factors, colon. And then I like to do 1, 2, 3 because it separates the factors and it doesn't run together. It allows my eye to rest a little bit and internalize the economic factors, either supply, demand, that are affecting the price.
Do you bold those
No, I don't. Yeah. But thanks. Any detailed questions, let me know, okay? Because it's all in the detail, right? Based on the following factors, 1, 2, and 3, period. Therefore, comma. We recommend the following, and then you want to bold 36 trades, colon, okay? Then you have the trade table, and I'll get into the trades later, and I'll get into, what these trades are on the derivative side today. So you have basically the underlying information you need to start the memos. But there's only 2 scenarios for the trades. Either you're forecasting prices to go up, or you're forecasting prices to go down. If you're forecasting prices to go up, you basically use these trades. If you're forecasting the prices to go down, you use these trades in the exact same words, okay? Very specific. I've worked on this for like 3-4 years. I think I got the format for the memo finally down, okay? I've been working on it iteratively over the last 4 years. And last semester was great. I really worked with the students, and we really got it nailed down. I mean, really got it nailed down. So the trades are going to be in this box, single-spaced. The indices, the ETFs, and the stocks, those are going to be centered, and they're going to be bolded, okay? Centered and bolded in the columns, and the columns are going to be equally spaced, okay? Not all distorted and stuff. And I'll get into it in a minute. Where it says indices, in the 3, and the 3, and the 5 basically indicate the number of indices, the number of exchange-traded funds, and the number of stocks that you're trading, okay? So it's the number times the trades is going to give you the total. And then the total of the subtotals is going to give you the total number of trades. You have to have at least a minimum of 36 trades. You got to have 3 indices, 3 exchange-traded funds, and 5 stocks, okay? And this is a stock, we're forecasting stock prices. So the 3 indices that we are going to use is we are going to use the Dow Jones Industrial Average, the Standard & Poor's S&P 500, and we are going to use the NASDAQ index, the NASD. The S&P 500, top 500 firms listed on the New York Stock Exchange. The Dow 30 is an index that goes back 167 years, which is somewhat representative of the stock market. And the NASDAQ index are mostly dominated by tech companies. So it's really a tech-dominated index, okay? And then what you're going to do is you're going to put codes, or you're going to list down in here Dow, S&P 500, NASDAQ. So you're going to tell me what those indices are. If you want to track more indices, that's fine, but I want at least those 3. And they're highly correlated to each other, because they're all stocks by publicly traded companies that trade on the New York Stock Exchange or the NASD, or made up in the Dow. Okay, so the trades, this is a prediction of stock prices to drop, and then I'll go through the trades again. But if you're forecasting stock prices to drop by 9% over the next 3 months, which is highly probable, within the probability range, you are going to write forward contracts. If you're forecasting it to go up, then you're going to buy the contracts. But if you think the prices are going to go down, you are going to write forward contracts. You are going to write futures contracts. You are going to write calls on futures, and you are going to buy puts on futures. When prices go down, you're going to be writing contracts, or you're going to be buying puts or writing calls. It's very mechanistic trading logic. Once you understand it, it just becomes mechanistic, okay? So 3 times 4 is 12. So I got the total trades for the indices. Exchange-traded funds. Exchange-traded funds are basically portfolios of securities in a fund, and the fund shares trade on the New York Stock Exchange, just like a stock, okay? And the exchange-traded funds basically mimic the companies that make up the stock indexes, okay? So they're replicating. What a lot of people did is what these stock indexes were invented, And mutual funds were then invented to track those indexes. In the last 5 to 10 years, there was product innovation where they invented a new security product called an exchange traded fund, or an ETF, which is basically at this point in time fully adopted by large institutional investors and smaller retail investors. The product is fully adopted at this point in time. So the trades where the exchange traded fund shares, since you're predicting it to go down, you are going to sell short. That is the trade. So if you open up a stock brokerage account and you think that stock prices are going to go down for the S&P 500, you could basically go short the S&P 500 exchange traded fund shares and make money as the price goes down. We can make money if prices go up. We can make money when prices go down. I can put together hedges if I think prices are going to go down and I'm going to get hurt. I can put together these derivative trades that either will take advantage of where we think the market's going to go, or we can hedge off market risk if we are being exposed to market risk, or our clients or our companies are being exposed to market risk. We can hedge off risk. We can also buy put options. When the prices go down, you buy put options and you make money when the prices go down. You can write call options. Well, call options, you make money when prices go up. When you write call options, you make money when prices go down. It's just the opposite. Okay? So if you understand the logic and you start to play with it, it becomes just very mechanistic and easy. Okay? Same thing with the stocks. If you think stock prices are going to go down, well, the indices are going to go down. The exchange traded funds, which are based on the indices, are going to go down. And the companies, the top 5 companies that make up the S&P 500 exchange traded fund and the S&P 500 index, they're all highly correlated, right? So the top 5 companies, if you go to the S&P 500 and look up the S&P 500 index, or if you go to Fidelity or Vanguard or Schwab or JP Morgan or Goldman or whoever, and look up their exchange traded funds that are basically mimic the Standard & Poor's 500 index, and look at the top 5 companies through their fact sheet. You can go in, Google it, go find Goldman Sachs, look at their S&P 500 exchange traded fund, pull up the fact sheet, and it's going to list the top 5 companies that make up the ETF and the indexes, and it'll give you the ticker symbols. You pick those top 5 companies within that ETF and or those indexes, and you list them down here by their ticker symbol. And you also, the exchange traded funds also have ticker symbols. Those ticker symbols are basically the code in which you would put into your trading system, or that you would give your broker to basically tell them to either buy or sell the stock, buy or go short the stock. So the ticker symbol is really the code in which the whole system is based on, okay? And it ties every stock on the New York Stock Exchange has a ticker symbol. Every trade that is made on those stocks are made through initially by putting in the ticker symbol, okay? So in this case, again, 3, 4, 12, 3, 3, 9, 5, 3, 15, they add up to a total of 36. And I would bold that too, down there. The 36, bold that too. So again, you're hitting the 36, 36, 36. Then underneath the table, again, you should have a space between the graph and the table. Do not have the text and or the graph above the table. There should be at least some spacing in there. You're going to have some bullet points, maybe 3 to 4 bullet points here, that are going to have key data referencing the factors, okay? So factor 1 will be the first bullet, factor 2 will be the second, factor 3 will be the third bullet, and you might have an extra bullet in there too. And you want to bold the key data in the bullets, in the bullet paragraphs, okay? And the text, when the text ends here, you have to have some white space. Do not have the text above the graphs, okay? There needs to be some space between the text and the graphs. The graphs themselves could be one of the 3 indices, one of the 3 ETFs, one of the 5 stocks will be the chart, okay? There's gotta be titles on the chart, and I gotta be able to read it. And the chart's gotta go back at least 2 years, because I wanna see if there's trend, okay? Is the stock trending up? Is it trending down? Did it hit its support? Has it hit its resistance and peak? What's going on? So I can actually use technical analysis within these graphs. I got fundamental analysis, I got trades, I got the charts, I got everything that I need in that one page. And then the last piece, it's really, really simple. You just copy the first paragraph and you bring it down to the concluding paragraph. And you only need to make 2 changes. You change, therefore we recommend from following to the above, you change it to the above, 36 trades, and you change the semicolon to a period, right? So when you're communicating, you come out with a really strong thesis, you go through the analysis, you go through the recommendations, and you tell me again at the end. Because a lot of the senior executives are probably 45 to 65 years old, and they need to be told again, and it's good communications to reinforce what you just communicated to people. So that's basically the memo format. Does anybody have any questions? Is it clear? Okay, yeah, I'm trying to get as specific as possible. The video will be up there so you can